Congratulations, Alan. And a remarkable career. I think if any of us had had just a quarter of that, or even a tenth of it, we'd be very, very happy. When you look back, is there any particular thing that you're most proud of?
That's a hard question to ask.
We ask the tough questions here.
I can't say proud of. I mean, when I started out in the venture business, it wasn't even called the venture business in 1970, although there were a few firms around. Kleiner Perkins, I believe, started within a year, Sequoia about a year, Arthur Rock, Warburg Pincus, actually the guy who's probably the leading guy in the whole field was a guy, Ned Heiser, who was running Allstate Insurance out of Chicago, who really kind of was the genesis of this. They consider as the father of venture capital was General Dorio, who was up at Harvard, who had this idea of growth stock investing.
Sure.
So I guess having been a pioneer, that's a self-appointed word, but having been at a very early stage in what has become an industry is a significant thing to look back on. But in terms of investments, you know, like everyone says, they were all our children. You know, most of them, a good number of them, thank God, rose to grow up and go to college.
Yes.
And get jobs. But a lot of them failed on the way. And I don't think I, you know, can point back to, I think probably the company that we formed that had the most significance in the world, which was done by one of my partners, was a company called Agaron. I just thought I haven't remembered that name for years, which was one of the first AIDS drugs, and that kind of, I would say, had an impact on society. We also invested in the first cellular company in 1981, Cellular Communications, which was, at that time, the cellular franchises were, believe it or not, auctioned off in a lottery by the US government for nothing. When you think back of that, we won Ohio for nothing. And of course, since then, those cellular franchises become worth billions, multiple billions. So I say being at the early edge of an industry is, I think that's something to look back with accomplishments and as a sense of accomplishment. I think that there have been a lot of achievements like that in the venture business.
Like you'd mentioned that you wish you'd had hung on your Apple stock, I think, at one point.
Well, that's easy to say. I mean, you know, yes. I mean, anything you hold on to is probably better off. Although I have one investment, which I will not name, but it was a company we started in the room next to mine with $50,000, and I watched it go through all its transitions and ultimately went public about 20 years ago. And I decided when the stock was distributed to the partners, not cash, that I would hold on to it. So I still hold on to it, and it's selling at about half its peak. But I haven't given up yet. It's doing great. The market's just not interested. Someday.
Interesting. So I know there are a number of younger professionals here on the VC and private equity side. In terms of career advice, can you give them sort of one do and one don't based on all of your experience?
I don't know. I don't think there's a do or don't. I think that we have found that the most successful investments we've made, not completely, but and it's probably becoming less and less so with all the young people starting business today. But if you can back a team that have worked together before in a similar industry, and there's a clear leader who left and his compatriots or her compatriots followed behind, that's been a pretty good indicator of success. In other words, the person obviously knows something about the industry, they've had experience, they stepped out and took a big chance, and then the other people who believed in that person voted with their feet, and came behind them, that's as good a vote as putting money behind somebody. And I'd say probably the opposite. If someone doesn't attract people they worked with before and try to go into a business they've never been in before and perhaps do it in a different city, at the same time we're going through a divorce, I would say those are all pretty good indicators that you ought to be cautious.
Now, a lot of people...
And I'm sorry, I mean, I'm being casual about that. I think you really look for someone who has a proprietary advantage. I mean, that's fundamental to the business. You'd like to have someone who's not a Me Too business that does bring something unique to the party. And I think that one of the biggest problems we have today, at least for us who are focused only on early stage venture, is that there are just too many companies that are all look alike, and that there's very little differential.
Before the bubble, everyone wanted to be a venture capitalist, and then things sort of went south, and then it sort of became a bad word. It seems like people are starting to get excited about venture again. I mean, if you're, say, a young person, would you recommend that somebody go into venture capital, or would you say they should become an entrepreneur?
I don't think there's a flood into the venture business today. I think there's a flood into starting up a company. I mean, people don't have any sense, at least my friends, most of whom are at later stages in life and run businesses, have no concept of all of what's happening in the incubating, startup, accelerator market. I mean, there must be today, I'm trying a number, but I'm probably not too far off, 4, 5 to 10,000 businesses in New York City alone that are sitting in a room or in a big open space working on a concept. I mean, you've got Dream It, you've got ERA. I mean, I went to ERA demo day the other day. There were 3 rooms going with 20 new startups showing their wares in each room. You go to demo day at New York Tech Stars, and if you go through this, how many of you have heard of something called WeWork?
Sure.
Okay. Well, WeWork is a phenomenon, which is in this city. I think it's now in San Francisco and Seattle and Los Angeles. They've taken over probably 10 buildings in New York, 10 office buildings, and from bottom to top have been refitted out for startups. And you don't have to necessarily be a pure startup, but you can get one desk, you can get a little room with 3 people in it, and they're taking that concept from a startup workplace to living spaces that are going to be attached, that people can get work and live in smaller spaces near each other, and it's a whole new concept. But I mean, they must have 1,000 people in one building here, and it's quite a phenomenon to see. Now the question is, how many of them are going to get financed? I think a lot of them will get seed money. Seed money seems to be a lot easier to get. A lot of angel investors, a lot of friends and family. The challenge is going to be when they go to get the A rounds.
Well, yeah.
They're going to need people like us then.
Well, exactly. So
and we just can't finance 10,000 businesses.
Now, LPs sort of moved away, especially like big ones like CalPERS, from VC after the bubble. They weren't seeing the returns. Now we're starting to see the returns come back. We're seeing more exits. Do you have any sense on whether LPs are going to start to come back into VC, or do you think funding levels will stay about where they are?
Well, I have to say not to be at all complacent, because I wrote a very famous blog. If any of you are looking to raise money, I haven't read it. It's become almost historic. I did it about 3 years ago, telling about what it was like to raise money in 2009. And people felt that if I could tell that story about what it was like to have 154 meetings and all the trials and travails you go through. I would say our last fund, which we raised early part of 2013, was a fraction of the time, and we had to turn people away because we have a good record at this point.
Exactly.
I mean, that's the point.
And that was 175.
That was 175 million, and we're doing something now. And I would say that there is a very good appetite. The dilemma that's faced right now is that most institutions are big, and therefore they have to invest large amounts of money. The concept I came back to the business with in 2006 was the opposite of what I had been doing for the last 35 years at Apex, which is we started out with 2 million. When I left, it was 30, and now the gentleman just said it's 40 billion. You can't do venture capital with $40 billion. Although I must say, as a plug for Apex, which is Alan Patricof Associates, for those of you who don't know, they, because it happened after me, are the investors in Candy Crush, which is going public this morning, King. I found out I actually have a very, very, very small fractional interest, residual interest. I was pleased. I called up to find out. It's too bad I wasn't there. I left a lot. But we started out with the idea of being a small fund. We are dedicated to staying a small fund because we believe that the venture business, that's what's needed, is people who are recognize that everybody is not going to be Candy Crush. We're not going to all be Box. We're not going to be Facebook. That 95, 98% of the venture-backed deals are going to get sold for under $100 million. So you better be investing in a small enough amount of money at a low enough valuation that you can make money at 100 million exit. Now, we've had at least 10 exits that are well over 100, but when we invested, our mathematical equations and extrapolations assume we would sell at 100. So we could make money at 100 million. The fact that it's more obviously has produced a very, very big success. But you can make money if you invest intelligently in a small size at a low valuation. It's increasingly harder, I admit, in the seed and A rounds. Now, the dilemma is that the institutions want to put big money in, so we lose a lot of investors who have the same problem that big venture funds have. A $500 billion venture fund's got to put $5–10 million to start with and overcapitalize, in my opinion, in many instances to start out before they know anything about it, and when the failure rate is pretty high. And so it's a kind of, what do you do? The funds, venture people raise more funds because they know that the institutions want to put money in bigger funds. They put money in bigger funds, and then the returns are not as good, and they're disappointed. I think that there is definitely a trend towards what we're doing, and I feel a little bit. I had something little to start with it in 2000. It's really happened since 2006. There are many, many more small funds today. And I think the trend is to small funds. And the challenge is to find institutions who are willing to accept that they can't put $50 million into a fund, and if they want to put $50 million, they got to go to a different class of funds. So it's a challenge. I admit. I mean, the bigger institutions have a problem of how they put huge amounts to work in this area without adopting the strategy and finding a whole bunch of funds like ours that they can, on a cumulative basis, get enough money to work.
So jumping back to M&A, I was surprised. I think you've had 23 exits, something like that, and all of them have been through acquisition.
Right. We haven't had one public IPO yet, and we've had 23 sales, and our IRR is we're way up in the top quartile, and we just sold a company you may have seen yesterday called Maker Studio. We sold to Disney yesterday. We have I'll tell you that, we have a $5 million investment. We own something like 15–16% of the company, and it got sold for $500 million in cash plus an earnout of another $450. So if it's $1 billion value, will come out very well. And our original expectation was to end up that the company would have $100 million if it was successful.
And they do YouTube programming.
Not that we didn't want to. Believe me, we wanted this kind of exit, but we didn't kid ourselves when we started out.
So I think there were something like 82 IPOs last year. It really started to come back. I think it was the most since 2007. I mean, what's your outlook for venture-backed IPOs, this year and beyond?
Well, I've spoken probably more than I should in a lot of TV and media, and I've been saying since 2006, one of the foundations of our fund in our original offering as recently as the last one, says we do not expect any of our exits will be through public offering, because the reality is the IPO market is just not there. Now, I've said it and said it and said it, and I keep getting reminded of it. I have to say that 2014, I'm changing the tune a little bit, maybe more than a little bit. The market is opening up. It is much more receptive today to smaller size offerings, because these companies haven't got enough money don't need enough money to raise money. They're not at that stage that they can go. I mean, in the old days, you could have someone came up to me before about a company I started called Datascope Corporation. We went public. I know it seems hard to believe, with a $2 million public offering. Ended up 25 years later getting sold for $700 million. Intel went public with an $8 million offering. I mean, that's inconceivable today. But you did have last week Castlight going public with a $150 million offering, but their revenues were $13 million. We have a private company called Vitals, which is very similar, and we're very excited about Castlight's success. And we had different expectations. Castlight was selling at a $3.5 billion valuation last week. It's come down in the market considerably. But the fact that you can take a company public with $13 million revenues tells you, boxed, 2-year-old company. So I don't think you have to have profits. You don't have to have, obviously, a lot of revenues. I think you have to have a very good growth story. You have to be a leader in the market. And you have to have something that's, differentiated, proprietary, whether it's patents or whatever, or know-how. But I think if you have those three combinations, I think you probably can tap the public market. And there are smaller size offerings that are now. The new IPO rules, I don't know how many of you are aware that Reg A is just being changed now from a $5 million to a $50 million cap. And you have the Jobs Act. Every company you see filing today is filing under the Jobs Act, which only needs 2 years of accounting, of audited statements. It doesn't have to have Section 4, which is the most onerous kind of review that public companies have to have. And there are a lot of things waived for it, so it's easier to go public, it's less expensive. So I think if I had to, make a statement today publicly, which I'm doing, I would think that there's a greater outlook today for public exits. But you said there were 88 public offerings last year. There must have been at least 3,000 venture deals done last year, that were publicly acknowledged. That doesn't count seed deals or anything else. So if my math is pretty good, it's a very, very small percentage go public. Now, of course, the ones that went public are from 5 years ago.
Now, I guess the other there's a good thing about the IPO market being open is, drives up M&A prices, which is good for your companies. But I think that the M&A
I want Facebook, I want Google. I mean, there are customers in a way. I mean, they're customers in a lot of ways. But I mean, all those companies that have lots of cash, I mean, there's so many of them today. I'll take their cash, although I'll take their stock too. In certain cases.
I mean, we just had Oculus yesterday by Facebook, which was sort of a weird deal, but
no revenues.
And
WhatsApp.
I mean, do you think? Yeah, exactly. You had WhatsApp. You had Oculus. Do you think that we're going to start to see Google start to actually make some bigger investments in order to sort of be like defensive moves against Facebook or some of these other larger tech companies who are sitting on cash?
I think they're all the customers for our companies. I mean, the list is very long. I mean, we sold a company last year to eBay. We sold yesterday. That's the third company we've sold to Disney. We've sold to Nielsen. I mean, the list is Warner Communications. I guess I have to think on my feet, but we've sold to a lot of public. Of course, our big sale was Buddy Media. We sold to Salesforce. We sold Pulse to LinkedIn.
Oh, yeah.
There are a lot of people with money out there and stock. In LinkedIn, we took stock. In Pulse, we took cash.
Are there any particular...
No, reversed. I'm sorry. In Pulse, we took stock. In LinkedIn, we took...
Are there any particular technologies or areas that you're really excited about today? I mean, the things that are in the news, drones, Bitcoin, wearable technology like Fitbit, Google Glass, things like that. Is there anything that you're really excited about?
I'm sorry to say that we are not in any one of those four. I don't say I'm sorry. We're not in those four. We've done a lot in content. We've had a big success through the YouTube environment,
Sure.
Maker Studio. We sold last year a company called Awesomeness TV to DreamWorks. We're just starting Russell Simmons. You're the first ones to know. It's closing today, I believe. We're investing in Russell Simmons' new company, which is called All Deaf Digital, ADD, appropriately called, which is going to be a new urban channel for YouTube and elsewhere. But in the same vein, we are doing a lot in the mobile area. We've done a lot in the payments area. We think there are real opportunities to disrupt the payments area.
Kind of like in the lending side?
Not as much lending as the way in which you said. We had Braintree, which we sold to eBay last year, which is a payment system. We have a company called Fortumo, which deals all over the world except for the United States. They're in 84 countries around the world, where you can play games and pay through your carrier billing. And we have a company called Accevo, which is doing wire transfers between countries. But we have a whole bunch of companies in the payment area, and we're looking at that all the time. They're new, disrupting the old ACH check cashing systems.
So I have to ask you about Bitcoin because it's just in the news so much. Is that something that you would look at?
I guess that's where age shows. I just, I think I understand what it is, but I don't get it. We
have a panel later.
I always learned that money was a store of value, and it had to have something underlying, even if it was only the full faith and credit of the United States, that little thing. And I think it has to have enormous liquidity, and there are a lot of people betting on it, and there are some very smart people betting on it. So I'm not betting specifically against them by selling it short, but I prefer to sit on the sidelines.
So I think we have time for one more question. Looking out 10 years, the venture industry has been sort of in a tumultuous market for the past 10 years, I think. What's your outlook 10 years? Do you think it's going to be days of wine and roses, or is it going to continue to be tough?
I think it's always a tough business. You're dealing with all kinds of people's emotions and personalities and interactions and technology. You have something and you think it's the greatest thing, and in the world we're in, with technology moving so fast, it's obsoleted the next day. So it's going to always be continued to be a business that's going to require lots of discipline. That's the major thing I can say to people today is, in this environment right now, I would exercise a lot of discipline, be willing to lose a deal to someone else who is paying more than is realistic, because they just are betting on something that's doesn't make any sense. We have several companies we have invested in where I'll give you one example. We invested in a company called Vidi, which we went into at $15 million valuation, and 4 months later, some venture capitalists put in $40 million at a $370 million valuation, and we just barely sold it recently and got our costs back, just barely. And that's always because they got carried away by the whole euphoria of Facebook buying Instagram, and we're in a moment of euphoria. You're seeing every day. You don't think that there are hundreds of thousands of entrepreneurs who read about WhatsApp and are now starting their own WhatsApp, and they have a dream of $16 billion or $19 billion. So answering your question specifically, I think the business is going to be terrific. I think if you're realistic about your expectations, you invest intelligently with discipline, and have some experience in doing it, I think there are so many opportunities. What I worry most about is all the young people, particularly young ones, who are doing these startups, who have so much enthusiasm and et cetera, and they're going to be a lot of disappointed people who are not going to be able. There's just enough money to finance the follow-on rounds for all these people, and so it's the wheat and the chaff are going to be separated, and it's probably going to be disheartening. Although it's probably a good learning experience. I mean, everybody leaving high school, leaving college to start businesses, and they're doing it because they just, you don't go to General Motors today. You start a company. You don't know what you're going to want to do, but you'll find an idea. It's not like a lot of people are driven by a passion that they really have some insight as to an opportunity in the market that they've studied, and they know what the size of the address market is, and they have the technology, and they know the differential. That's what we're headed for. So we're going to, but I think in terms of venture businesses, it looks great.
What about, I mean, private equity? I mean, it was interesting. I mean, you could have obviously stayed very comfortable at Apex. Things were growing, and it's massive now, and yet you decided to go.
I wasn't thrown out.
Oh, I didn't say you were thrown out, but I mean, I remember talking to you back then, and you said you wanted to basically go back to basics.
That's what I did. Back to the future, I said.
Why is that? Is it that you really love the startup process?
No, well, I think there's a great excitement. We helped start the Huffington Post. It's a great sense of satisfaction of being involved in an early stage of something. Audibles, the whole, books, digitally delivered books, YouTube environment. There's a lot more excitement than the last deal we did while I was at Apex. Was we gave the money to Philips Van Heusen to buy Calvin Klein, which was a great deal, and it was terrific, but and the next deal they did after I left was buying Tommy Hilfiger. There's much more excitement in a young, much higher risk. And I tell everybody in my office, one deal at Apex will make more than all the money we've made for the last 7 years in all the companies we've invested in. I'm sure of it. So it's a different kind of business. But I also strongly believed that the venture, Apex was no longer a venture firm, but the venture business had the wrong formula. And so when we started Graycroft, I put together a set of parameters that we were going to invest by. We've committed to keep our fund under $200 million. That's a big statement, because we could have been way over that last time, and I don't know what the next time what we could raise, but we said we're going to be a small fund. That's a big deal. Not many people do it. We go into investors and they say they want to put 50 million. We say we can't take your money. So we have a small fund. We don't go on boards. We don't care about leading. We don't assume it's going to go public. We don't care what percentage we own. So these are all things that I saw happening in the venture business. Most venture firms of size have a minimum size of investment. Most of them have absolutely a minimum percentage ownership of 20%, and in many cases it's now 25 and 30, but 20% is the magic number. They always have to have at least 1 or 2 people on the board. All these they have to be, this and that. And we come into an entrepreneur or to a fellow venture capitalist and say, you can have all those things. We'll take the small part. We don't care the percentage. We don't care anything. But we do care about valuation. We're very valuation sensitive.
You had talked about board seats before. Can you remind me, what's the philosophy there about why it's not that important to be on the board of a startup?
I've spent hours explaining this, and most people who invest with us get it. I won't do the test I usually do, is how many people are on a board, but I can, without raising hands, I'm sure many of you are on boards. How many of you have ever, that I will ask for hands, how many of you have ever been on a board where the vote was 5-4? That's why we don't go on boards. Most venture people own minority positions. They have 1 or 2 seats out of 3 or 5 or 7. So their vote really doesn't turn the matter. What's more important, which is part of our legal agreements, is we are an observer on every board. We get every piece of paper that a board member gets. We are invited to every board meeting without exclusion. We just don't vote, and we don't go in the audit committee or the compensation committee or the corporate governance committee, so that it gives us more time to do a lot of other things. We spend all our time helping the companies get business. That's all the people in our office, all they do all day is they're out getting customers for our companies. That's what we've made a cause célèbre. So, and by the way, this concept resonates with entrepreneurs, and it resonates with a reasonable number of venture capitalists. We've done venture partnered. We always have a partner. Always. We have not one deal in our portfolio is just us. And that's, again, part of what I'm learning of all the years. That's the wisdom I've gotten from all the years of what mistakes we've made when we've made them. And I think that if you follow those principles, you're a good partner for an entrepreneur and you're a good partner for another venture firm.
You know, I have to share this. So when Alan was saying that what they do is help their companies get customers, he's not blowing smoke. We were sitting out
exactly
by the coffee.
Good proof. Yeah.
And he was pitching my colleague on one of his companies that does a conference, basically a conference app.
It does meeting and event software.
And when he said, "Oh, you know, I don't have my card with me," he insisted that Mark write down his email.
And I assure you, someone will contact him this afternoon. I want to make. I should make reserve one comment. When I said we don't require it, we are probably on a quarter of the boards, but not because we insisted on it. It's the entrepreneur made it a condition of us investing in the company. So we are on boards. I am personally not on any boards. I'm an observer on about 4 or 5 boards. But we end up having to go on board. And sometimes where certain conditions are that we have to take the board seat, but we don't require it. There's a big difference if you don't say to an entrepreneur, and we must have a board seat because he's got 5 other venture people who want the board seat. We say to him, take them. Makes your life easy.
You know, jumping back to the, trying to get business or get the word out about your portfolio companies, do you have sort of any sort of formal process in place, or is it just understood that all of you and your partners are that's part of what you do?
No, it's what we do all day. We run we call digital media days as often as we can, in which we go to GE, we go to IBM, we go to General Motors, we go to, you name it, they've all done it. Every ad agency, and we give them a list of 10 companies they think that would be appropriate, and the only condition is they have to have people in the room who could be customers. And we've done it with MasterCard and American, I could go on and on, American Express. Then we run angel breakfasts. Then we run CTO meetings. And we have a big summit out at my home. We're doing this year in June 1st for 2 days, and we'll have 80 people from the media, advertising, brands, and we have about 35 of our companies come. And we give them a couple of days of interaction, and that's built a pretty good, reputation for the firm in terms of actually. I mean, if you ask any one of our CEOs, they'll say nobody in their board or no investor works as much as we do to try to get. The hardest thing for young companies is to get introductions to someone who can actually give them a purchase order.
Sure.